Hello, everyone, and welcome to Staying Ahead of the Curve. I'm Jeff Snyder, Vice President, Senior Consultant with CAMAC Retirement Group, and I'm joined today by the Executive Vice President for PIMCO's Defined Contribution Practice, Stacy Schaus. Stacy, thanks for joining us on the show today.
Yeah, thank you for having me.
So I know we're going to talk about successful defined contribution menu design and target date funds, but before that, we're here at the DCIA Public Policy Forum, and wondering if we could take a few moments. You're one of the inaugural members, the founding members of DCIA. Talk a little bit about the organization, because it's very prestigious. I'm not sure the audience in totality is aware of all the work that's being done here.
Well, it's a great organization. It's amazing how rapidly it's grown, and it's brought together the community of defined contribution professionals. So if you look at the membership, you have all of the investment management companies, the major consulting firms, the lawyers, all the other experts coming together in a community to work on making defined contribution plans better. And there's a spirit around that that started with the inaugural meetings on how do we make defined contribution plans better. If you look at the name, it's Defined Contribution Institutional Investment Association. So there's always been a focus on institutional plan design. And that means support of everything from custom target strategies to white label strategies to moving the plans forward so that they're as effective as possible for plan participants.
And what I've always liked about DCIA is the camaraderie. You've got the various points of view that are being discussed, and everyone's kind of really paying it forward. And let's talk a little bit about the committee structures. And you've got several committees that representatives from the organization are all participating in. Could you talk a little bit about the committee structure? The types of committees and what people are kind of at a high level working on. You don't have to get into the nuanced specifics.
Well, the one that I'm most involved in right now is the Global Committee. So this morning we met and we had a representative from the UK and one from Australia. And the group of us were looking at the UK development in many different respects. Now they have mandatory auto-enrollment into defined contribution plans, and they no longer require annuitization. So what does that mean as we think about our own country's plan design? Should we have mandatory auto-enrollment? Should we have any requirement in terms of retirement income, annuitization, otherwise? And then on the Australia side, as we know, it's mandatory auto-enrollment, but people can't opt out. And they also do not have a retirement income requirement, no annuitization requirement. So as we look as a community of defined contribution professionals, and as we try to make these plans better, the question is, can we learn from others? So that's one committee. If we look at other committees that have been in place from the beginning with DCIA, you have public policy, and we're sitting at the Public Policy Forum. And this was the first forum that DCIA held, and every year it's gathered more and more interest, and we see our top government leaders, the Department of Labor, our senators, congressmen, women, coming out to talk to us because they know defined contribution is so important to retirement security in America. So public policy, there's an investment committee looking at investment design, operations, research. We're now also looking at whether there should be a research group or effort that's broader. And so we'll continue to evolve, and it is very exciting. It's a great community. It's great to work with everyone on the committee.
Absolutely. So thanks for providing updates. So now this is our first book club. So we now have an Asset TV, CAMAC Retirement, and Staying Ahead of the Curve book club. So our first book, Stacy's got a new book out talking about successful defined contribution investment design. I'll put that up like Oprah would do. So let's kind of, if you could take us through a little bit about your thesis and things that you're talking about in the book, and kind of, begin to bring that to light.
Okay. So this book has been 10 years in the making, basically. You're familiar, as you know, with the PIMCO DC Dialogue series. And over a 10-year period, we were interviewing plan sponsors, consultants, legal experts, behavioral research experts, academics, people like Harry Markowitz and Richard Thaler. So this book, it's called Successful Defined Contribution Investment Design, and is designed to help a plan sponsor think through how to design a plan. So it brings together 10 years of thought leadership and gives them views from plan sponsors, consultants, others on how they may want to think about designing a plan. So successful, if we start with that, the question is, what is your defined contribution plan for? What's its objective? And even Harry Markowitz, if we go back and we ask him, how do you evaluate an investment? He would tell you always relative to the objective. So the risk is that you not meet the objective. So what is the objective for a defined contribution? It's to be able to provide retirement income for an individual in retirement. And that's primarily true. Very, very few individuals have defined benefit plans today. They'll be looking to their Social Security payments, they'll look to their defined contribution plan. So we need to be able to design the defined contribution plan to meet the retirement income needs in real terms, in inflation-adjusted terms. So the book's all about that. How do we design a plan to align the investment structure to be successful? How do we make sure that they're designed so that people have the money that they need to retire? And then the book's laid out in a couple of sections. So we look at defaults first, and as we know, target dates, target risk are balanced, or managed accounts are the qualified default investment alternatives. Target dates are the primary focus. That's where the majority of the money is going. That's what we anticipate in the future as well. And then the question is, what type? Should they be custom? Should they be packaged? The consultant community, and we put this in the book, has suggested that target dates for plans that are over $1 billion should be custom. Plans under $1 billion, now they would suggest an active-passive blend, which makes sense because you want the best of active management, you want the low fees of passive management, so bringing them together. Right? Exactly. And we also talk about where active, where passive, and we've been running, as you know, for the last 10, now 11 years, the consultant survey, and the consultants agree that there are certain assets that should be actively managed. Non-US bonds, non-US equity, US bonds, less efficient asset classes such as small caps. But then they would agree that large cap US equity, if you can use that passively and bring the cost down, great. So those are some of the concepts we talk about at the beginning. And then we go through the core. We look at how many strategies, and the focus is on the 4 risk pillars. And the consultants would agree with this as well, that you want to have a capital preservation fund, you want to have fixed income, you want to have equity. They also vastly agree and support having inflation hedging securities, which we believe are fundamental. Those align best to the objective of a target date, which is to meet a real income need in retirement. So the book talks through each one. What about capital preservation? There is strong support for stable value. What about fixed income? There's support for having 2 options from the consultant community, one being core or core plus, and then the second being more income oriented. And the income could come from a multi-sector type strategy, it could come from high yield, but generally there's support for a multi-sector, a blend of those. Then we go into equity, where the consultants are suggesting 6 different investment options. And this is where they would bring in passive management as well. So they would suggest a large cap, possibly a SMID type strategy, and then a non-US. And then they may put the passive strategies in those categories too. And then finally, inflation hedging, where TIPS or linkers, Treasury inflation protected securities, are at the top of their list. And then second, they would add in real estate, and they would add in commodities. So those are the 3 most important TIPS, commodities, and real estate. We also talk about alternatives. I mean, that's been a big topic. should alternatives be put into defined contribution plans or not? There's support for alternatives, not on the core as much, but putting them within custom strategies.
In a target date
In
structure.
custom.
And that's something that we're
Mhm.
actually dealing with as a consulting firm. We have clients who are actually interested in adding private equity or illiquid investments to the target date allocation. And how do you record keep that? How do you deal with some of the infrastructure issues that exist today? Because that kind of gets in the way. You've got the practical application and the theoretical, where it does make sense. You're doing it in a defined benefit plan. So let's apply the private markets to a DC plan. But we've got to overcome those barriers.
Yeah, and so the alternatives chapter looks at alternatives in three categories. And the first is looking at what would add diversification, reducing risk, and also add return opportunities. So you're looking for assets that give you an opportunity for diversification relative to stocks, bonds, and inflation hedging. And so the consultants would take you to a global tactical asset allocation strategy first, fully liquid. Then they would look at multi-sector liquid type alternatives. And then the third category would be the less liquid, so private equity, private real estate. I fully agree that these types of assets belong in, one, for risk reduction, but also opportunity. And personally, what I'd love to see is us to move away from having a daily valued environment for defined contribution, because it's such a long horizon investment.
When I first started in the industry, and actually at Hare, we had quarterly and semi-annual valuations, and now we've kind of gotten into this daily valued environment where people almost feel compelled from listening to what's going on in the market every day to make change. Mm-hmm. And this is a long-term opportunity. This is not something that you're doing day to day. You've got to balance that against distributions and some like unnecessary or unforeseeable emergency withdrawals and things like that. But I think we tend to agree. I mean, this is something you're saving for the future. And when you look at some of these global retirement plans, like the superannuation plan and others, I mean, there's more illiquidity than exists today in the U.S. system.
Yeah, it's silly. I remember working in this field in the early 90s, 1991, and I was working with Hewitt at the time, and the head of the 401k business said, daily valuation, this is silly, this won't last. It doesn't make any sense. Why would you ever move this direction? So I don't think people understand the cost, both in opportunity and the cost of having that liquidity in plans. So the more we can move plans toward being truly institutional, which means we're borrowing the very best thinking from defined benefit investment management and bringing it over into defined contribution, I think the better. And with that, if you look at defined benefit plans, we've been very focused on looking at the liability and how are we doing relative to the liability. Most DB plans are paid out nominally, so that's a big difference. If we shift over to defined contribution, there's a liability too, but it's a real liability, which is much more difficult to manage too.
And that participant has a liability, so it's not at the corporate level or the plan level. Last question. It's always important to have a solid foundation, a solid investment venue. How important is communications and education to plan participants? DC is very different from DB. In your estimation, to be able to communicate this so people do the right thing. We can automate, but making sure that people understand what they're actually getting themselves into and what they need to do.
Well, it's important, but I think what we've all learned is the design of the plan is even more important. In behavioral research and all the years we've been at this, we know if we automatically put people in, they're likely to stay in. We spent so much time trying to encourage people to participate. Well, it's so much easier to just put them in.
And millions of dollars.
In many,
tens of millions of dollars.
Tens of millions of dollars, right.
30-year period.
Well, I think the good thing about communications, so now instead of talking about why participate, they just do. And why put or increase your contribution rate, they just do, because we put them on auto escalation. Investment management, changing your allocation over time, they just do, because if they're in well-structured target dates, that's great. And now I think we can spend our time and money on the more important conversation, which is the one around retirement planning. What do they need? How do they get there? And that's the end of the book. It talks about retirement income. What should we do? And I think the first question is, do plan sponsors want people to stay in their plan or not? The larger the plan, the more institutional its investment management, the better off people are if they do stay in.
Federal Thrift Plan. We're here in DC. The Federal Thrift Plan is probably the largest and most economically efficient. So why would you leave?
Yeah, so if you have a very well-designed, institutionally priced plan, you also have the fiduciary, the plan sponsor, overseeing it. So you would want to stay, but then you need access to your money. So that's going to be very important. Partial withdrawals. And then you need to have the right investment structure. And this is something we've asked the consultants about for years. And they would point first to your at-retirement target date strategies. And the Employee Benefit Research Institute data shows that people over 60, they increasingly are keeping their money in target date strategies too. So the default is not just for the accumulation phase, it's carrying into the retirement phase. So we need to make sure that that's right. And then second to that, we need to look at where do they have opportunities for income. So stable value can be very important. And again, having income-oriented strategies. That came up in our consultant survey again, having a multi-sector. So we'll see more interest in bringing in higher yielding and yet still capital preservation focused opportunities for participants, both in accumulation and accumulation.
Well, Stacy, thank you very much for sharing, talking about the SIA, the work that's being done. Thank you very much for sharing the information about your book, and we'll look forward to having you back some point on the show again.
Great. It was a pleasure to be the first book club.
Yeah, excellent. Oprah, look out.
Okay.
Thank you.
Thanks, Jeff.
Bye-bye.
I appreciate it.